What does that look like, on what does that look like 30 years out, and how detrimental can that be to their retirement? I don't care if they're 30 or 55, because somewhere along the way we were all told we'd be in a lower tax bracket in retirement. Now, that might be true for people retiring today, but guys like you and I and people that still have a run going, we have a TBD tax rate that we're deferring. So when I started to understand, one of the books behind me is Tax Free Retirement, and I was able to take those concepts to a lot of different professionals. And now what we've created is what's called a client advisory team, which every client is surrounded with the realtor, of course, ourselves as the lender, and then I will go bring in a financial advisor. And then if that advisor doesn't sell financial products, a life insurance specialist, a CPA, and an estate planning attorney. So we're making sure that decisions today are in line with the goals that they have 10, 20, 30, 40 years from now. And we want to make sure that there's not a mistake made today that can impact that goal in the future. So I can't do that by myself, and I also didn't know how to communicate that to each one of those professionals. But allowing myself to change the business model, and I ate dirt through that time period, right? Because it's tough going from having unlimited amounts of leads that you've got your team calling on, to like, all right, now I got to go deliver these value propositions to high level professionals that at first I was having an imposter syndrome, right? I was like, do I belong in this room? What not? But because of the focus of everything being on the client first, it was more of a magnet to those other professionals. So the business model changed completely, from consumer direct to relationships.
Yeah, very interesting. I love how you indicated, of course, the TBD tax problem, and we like to talk to people about what would you rather pay tax on, the harvest or the seed? And the reality is that there's an awful lot of spending happening by most national governments around the world, certainly in Canada, certainly in the United States. And those unfunded liabilities have to be paid by someone. When the entire revenue stream for a nation is the backs of the taxpayer, that's the only place they can get the money. And so if they're not taking it now, they're going to have to take it eventually. So I think that's really important for people to understand. I'm glad that you brought that up. It's something we talk about as well, and just being clear that why would you put money away to pay tax at some unknown future when you're also complaining about how the government's spending the money now, knowing that they have to spend more of it? There's a very different, it's kind of like a mental boxing match that you're having with yourself in that scenario. So when you can get people clear on those things by asking good questions, it's very interesting to see how they process that themselves and come to a conclusion that's right for them. We're not trying to guide people down a certain path, but it's good. There's importance of asking good questions. And so when you take this client focused approach, I'm guessing that's a big part of the approach, because you're really trying to get clear on this deal or this property or this thing that you're purchasing. How is this in alignment with some of the things you want to do in the bigger future that you have set out for yourself?
That's a great question as well. So that part, especially on the retirement planning side, is really the direction that we want to go. And not to say that we would ever get away from the mortgage side, because the mortgage is where we're able to identify those challenges. You hit right on the tax bomb. As soon as I saw David McKnight's Power of Zero documentary, and then I read the book, I'm like, all right, we have a serious, like you just mentioned, the unfunded liabilities. Did a presentation yesterday. I think right now U.S. debt clock shows 36 trillion in national debt. You take those unfunded liabilities, Social Security and Medicare and Medicaid, add them in, and I think we were looking at 213 trillion, or it might be as wild as 223 trillion. I say that to say that a year ago when I did the same presentation, it was at 187 trillion. So the trillions are ticking at a significant rate. So that really made me not only interested, but passionate about the retirement side of things and making sure that, I'm not trying to be a tax free nut. I want to be at the same time. Um, I need to be able to forecast a little bit. I'm not telling people, where to put their money or to, run from financial advisors. But if I'm a mortgage guy and I pull up your retirement portfolio and I can quickly calculate you've got an 86% chance of running out of money, that's a problem. That the advisors are not having these conversations. I shouldn't say all of them, but some of the big boys, right, are not having the conversations about tax risk, longevity risk, all these different factors that a lot of the methods now are they stem from the money rules from the Great Depression, right? And the rules of money have changed 10 times since then, but we still want to stick to these old school methods because Dave Ramsey said so. And I'm not bashing Dave Ramsey. I think he could be great for getting out of debt, but at the same time, there's a lot of bad information going on based on what's going on today. And so the future of it is we're very heavy in the HECM, aka reverse mortgage space, and we dispel a lot of those myths around there. And it's been proven. FINRA had instigated a study by the Journal of Financial Planning. They launched a 12-page white paper, which was proven that the earlier in retirement a reverse mortgage was taken, it would increase cash flow survival by 8 times. Meaning, instead of taking $1 million portfolio, drawing it to zero, and then coming in with a HECM as a last resort because there's a tax-free line of credit, we actually bring in the HECM or the reverse mortgage immediately at their 62nd or reverse mortgage birthday. And what we do is called a coordinated withdrawal strategy, meaning if the market is down, we're going to pull off the tax-free line of credit from the HECM, allow the portfolio to recover. And if when the market is up, we'll pull from the market, allow that their tax-free line of credit to grow and compound. And then with guys like yourself or anybody in the retirement planning space, sometimes we'll use an annuity to supercharge the payoff of the mortgage, but we're taking that annuity, which is taxable or tax deferred, and placing it somewhere where it becomes tax free and a growth component. So it's just some equity repositioning around retirement. Sorry for the long winded answer, but that's where we're headed.
No, it's great. I mean, what you're really identifying is using the home equity as a volatility buffer. But the only way you can do that is to have the buffer in place. And so you can have the house and you can have the equity in the house. But there's this commercial that used to exist. One of the banks in Canada did years and years ago, and it was two little boys walking around with flashlights in the dark at night. And the one boy says to the other, says, "What are we looking for? Equity. Dad said it was in the walls." You know? And so there's only two ways to unlock equity, and you either borrow against or you sell. And if you sell, you don't have a house. And so that doesn't always make sense. And equity can be unlocked in several areas. We always think about equity in a housing scenario. We don't necessarily think about it in other areas. And that's part of where, the training that we do around becoming your own banker happens, the infinite banking concept. But there's lots of ways to build and create equity, but it's what level and degree do you have control? So what I hear, Mike, that you're talking about is creating an environment of education to help people recognize there are different things that could be done. If you implement these things, you have the choice. And if you have the choice, then you can be empowered to make the decision that's right for you. There's a big difference between that versus saying, hey, here's where you can go put all your money and go knock your socks off. And a lot of people just follow almost blindly the advice of someone, and they'll willingly nilly throw their money at ABC financial product without having any understanding of it. And then the result is something goes sideways or the market tanks. And the result is they're left with a lot less money. And then they go looking for someone to blame, but they're not pointing the finger where it belongs, which is right back at themselves because they didn't take an ownership stake in their own money.
100%. And where that reverse mortgage is the line of credit that comes with the reverse. The difference is a lot of advisors that tell us, well, why don't we just take a home equity line of credit. Well, that creates a 30-year mandatory payment that amortizes every month versus the way that the reverse mortgage works in the United States is that it compounds every single month at the same rate that it's amortizing. So if you're paying down the balance, you're doing two things. You're paying down the balance, but simultaneously helping that line of credit grow. To your point, they may not need it right now, but when they're not solving for things like long-term care or they've thrown their money, I mean, we're coming off of a bull run right now of 12 to 13 years that I don't know. And I don't, not trying to be a pessimist, but more of a realist, we are on a potential another lost decade, right? Where you had $1 million in 2000. And in 2010, you were left with 980,000 because of the ups and downs sort of wiped themselves out. So, when we start to talk to advisors and anybody in the mortgage planning thing about the reverse being the number one hedge against sequence of returns risk, we start to get their attention because again, let's just say there's 4 down years in a row. Well, that portfolio isn't going to get destroyed as much as it would had that buffer asset, like you said, not been put in place.
Yeah, the power to be able to make your decisions and be in control of them. There's also another unique advantage that's being created where you can levelize taxable income if you know what the income is going to be. If you know what you're taking out, you know what you need, you can maybe augment or levelize as necessary without having to increase to a future tax rate and what have you. So there's a lot of control aspects there. Really appreciate you sharing all those, Mike. Love that. Now, we're going to talk more about some of these strategies when we come back after this important commercial break.